Hong Kong Crypto Regulatory Series. Hong Kong Crypto Regulation. The regulatory position in Hong Kong regarding virtual assets, that is digital tokens, including cryptocurrencies, such as Bitcoin and ICO tokens, is that these are unregulated. Except to the extent they constitute securities, within the definition under Hong Kong's Securities and Futures Ordinance. On the 1st of November 2018, Hong Kong's Securities and Futures Commission published new regulatory standards, which apply to virtual asset portfolio managers and distributors of virtual asset funds, that are already required to be licensed. Separately, the SFC is inviting virtual asset trading platforms and exchanges, which are interested in becoming licensed to join the SFC's regulatory sandbox, with a view to potentially becoming licensed, if the SFC determines that they are appropriate for licensing, following its assessment of their performance in the sandbox. The initiative is an important step forward, as it demonstrates the SFC's willingness to engage with participants in the crypto industry. There have been calls from the industry to introduce regulation, in order to create legitimacy for players willing to comply with regulatory standards. The latest guidance on virtual asset portfolio managers and distributors of virtual asset funds will be particularly welcome to fund managers, which manage and distribute virtual asset funds, in addition to traditional securities funds, as it clarifies the applicable regulatory standards. The requirements for fund distributors of third-party virtual asset funds are less likely to be welcomed, given the extensive due diligence they will have to perform on funds, their fund managers, and counterparties. As regards the proposed licensing of trading platforms and exchanges, the proposed regulatory requirements are likely to be seen as excessively burdensome. It will be interesting to see whether exchanges' desire for the credibility, which comes with licensing, will make them willing to submit to the additional regulatory burden. Regulating around the edges. Essentially, the SFC is trying to impose regulation, where it can. As it has previously spelled out, where a virtual asset constitutes a security, i.e., it carries rights equivalent to traditional securities, such as shares, debentures, or interests in a collective investment scheme, or a futures contract, it is already regulated by the SFC. Accordingly, licensing requirements apply to firms carrying on regulated activities, in relation to such virtual assets. Licensing requirements, thus apply to an exchange, providing trading services for virtual assets, which are securities, or futures, or a firm managing funds investing in them. However, the SFC's regulatory jurisdiction does not extend to the many virtual assets, which are not securities, or futures contracts, which the SFC refers to as non-SF virtual assets. Thus an exchange which only trades non-SF virtual assets, or a firm which only manages funds investing in non-SF virtual assets, is completely unregulated. Primary market issues, and offers of virtual assets, such as ICOs, which are not securities, also remain unregulated. Virtual asset exchanges. The proposals for potentially regulating virtual asset exchanges essentially involve an entirely voluntary process, whereby exchanges wanting to be licensed would operate within the SFC's regulatory sandbox. If the SFC decides to proceed with licensing with virtual asset exchanges, which is by no means a given, it would be a licensing condition that the exchange trades at least one virtual asset which is a security, in order to bring the exchange within the SFC's regulatory jurisdiction. Once it is, the SFC would apply its regulatory framework to all activities of the exchange, irrespective of whether they involve virtual assets, which are securities or not. Virtual asset portfolio managers and virtual asset fund distributors. The SFC is imposing regulation on virtual asset portfolio managers and virtual asset fund distributors, which are already required to be licensed either because they additionally manage portfolios of traditional securities, or futures contracts, which requires an asset management license, or they distribute funds investing solely in non-SF virtual assets. Fund distribution requires a securities dealer license, because a fund constitutes a security, irrespective of whether the fund invests in virtual assets, which are securities or not. The SFC has applied additional licensing conditions to both types of firm, to the extent that they manage portfolios, or portions of portfolios, that invest in virtual assets. Portfolio management includes both fund management and management of discretionary accounts, in the form of an investment mandate, or a predefined model portfolio. Firms distributing virtual asset funds, whether as fund managers under an asset management license, or as fund distributors under a securities dealer license, are required to comply with a. The SFC's regulatory framework for licensed corporations, including its Code of Conduct for persons licensed by, or registered with the SFC Code of Conduct, including among others, Know Your Client KYC, and AML, and CTF obligations, as well as the obligation to ensure the suitability of recommendations, and solicitations to clients, and b. Additional requirements including extensive due diligence, in relation to the virtual asset funds they distribute, their fund managers, and counterparties. The impetus for regulation. The Financial Action Task Force, FATF, the setter of international standards on anti-money laundering, and counter-terrorist financing, revised its recommendations in October 2018, to require member countries, which include Hong Kong, to regulate virtual asset service providers, which include crypto exchanges for anti-money laundering, and counter-terrorist financing purposes, and impose licensing, or registration obligations on them, so that their compliance with anti-money laundering, and counter-terrorist financing standards, can be monitored. The Financial Action Task Force is due to issue further guidance, on a risk-based approach, to regulating virtual asset service providers, in June 2019. As a result, a number of jurisdictions are in the process of bringing crypto exchanges within the scope of their anti-money laundering, and counter-terrorist financing, and licensing regimes. In Singapore, for example, a payment services bill is currently going through the legislative process, and will require cryptocurrency exchanges to be licensed, and subject to anti-money laundering, and counter-terrorist financing obligations. Further lectures cover the current Hong Kong regulatory framework for virtual assets.